Hello and welcome to this video. Today we're going to be doing a club account question, specifically 2016 question 3. It's a 60 mark question. Just like a standard club account 60 marker, we are given all the information we need about our assets and our liabilities at the start of the year. So we're doing for 2015. Clubhouse, bar stock, equipment to cost, bar debtors, life membership is standard. Then we have these wages due, levy reserve fund, subscriptions received in advance, investment interest due. We're then told of the financial activities of the club, receipts and payments as always, and we know that there's little nuggets in here that will need to go into the accumulated fund as well. And we're then given a few adjustments. Standard closing stock, investment interest due, equipment, so depreciation, the long adjustment for subscriptions, writing off life membership over 10 years, something about a dishonored check, so that's kind of not something we see every time this question comes up, and we're told about debtors and creditors at the end of the year. So a very nice question if you enjoy these kind of club accounts and you don't feel like doing a question 1. We need to get the accumulated fund, show the income and expenditure, and a nice theory question, distinguish between a levy and a life membership, and explain how both are treated in the accounts. So the first thing I like to look at is the accumulated fund. So I'll kind of pick out some of the receipts and payments that will go into the accumulated fund, and do those adjustments before I kind of do anything else. Because about 40% of the question, or like 25 marks out of the 60 marks, are going for the accumulated fund for the 60 mark questions. So to kind of help us at the beginning, I think that this is a very important, let's say, box for anything in financial maths really. So as I was talking about, everything up here is to do with assets or liabilities, but we see things like wages, that's an expense. We see subscriptions, that's an income. We see investment interest, that's also an income. So how are these things either an asset or a liability? So what makes these things an asset or a liability, and more specifically their current assets or liabilities, meaning that they should be paid to us, or we should pay them essentially within 1 year. So if we have a gain and it is due, I like to think of it as, well, someone owes me money essentially, and if someone is holding money for me, or I am owed money by someone, which sounds like a debtor, that would be an asset. So a gain that is a due is an asset. Then the opposite is the sense for a prepayment. So if someone has, let's say if someone's renting for us or something, or for example, this is subscription based. So if people in 2014 have given me the membership fee for 2015, I'm essentially holding that money for them, and until the time has come for them to pay, for the subscription to actually be paid, it's almost like a liability. We're holding it for them, and they haven't used up, let's say, the utility from that. So that would make a gain prepaid a liability. And then the opposite. So an expense due is a liability. Because if I haven't paid wages, I essentially owe someone money, which is what a creditor is. And we know that creditors are liabilities, so it's kind of the same understanding there. And then again, the opposite. If I have prepaid an expense, well, it's like I haven't used up the utility of that expense, for example, light and heat. So I've just given the light and heat company money, and they essentially will hold on to that money, or they almost as if they owe me that money until I've used up the light and heat that I've paid for. So maybe some of the explanation can be small bit misleading or small bit confusing, but in general, I find that a very nice way to think about it. And I think if you're starting off, even just referencing this table will help a lot, and then eventually it becomes second nature and you don't even have to think about the table anymore. You see expense, you see it's due, and you say that's a liability. You see a gain, you see it's prepaid, liability, and so on and so on. So that's just what I like to do anyway. And then automatically we would know that Clubhouse, we would now know that subscriptions received in advance is a gain prepaid, liability. Investment interest due, well, that's a gain due, that's an asset. Levy reserve fund, we know, is a liability, because again, we're essentially holding. So what a levy is it's money you take from your membership, or sorry, from your members, in order to pay for a large capital spending, like a clubhouse, maybe a big upgrade for something, a new tennis court, and you essentially hold the money until you've received enough to pay for it, and it goes out. So the levy is kept until the money is used for the specific purpose, and if it's not used, then you should be giving it back to your members. Wages due, so we know wages is an expense. An expense due is a liability, so we know that the wages due that's an L there as well. So now all of these figures are quite straightforward when we want to input them. So as well as that, the first two adjustments that I like to look at, because it will help the accumulated fund all the time, is this interest, as well as a bank loan. So here it is, this one here. Now the other one that I know will go into the accumulated fund is right here, the bank current account balance. This is essentially either a bank surplus or a bank overdraft. So if it's in the payments, that means, so 8,500 is money I have given to the bank to pay for an overdraft. So I owe the bank money on the 1st of the 1st, 2015, so that is a liability. If it's in the receipts, it means you have a surplus of money in the bank. That's an asset. So this here is a liability. A bank loan is a liability because we've gotten money from the bank that we need to give back to them. So it's as if we're holding that money until we give it back. So we owe money to the bank, so they are a creditor. Investment, if I've given a capital investment to someone, they're holding the money for me, so they are an asset to me. So we know that this is an asset. So the first two adjustments we'll do is investment and then bank loan. So we know that 2,400 is interest on 4% of investments. So we'll do, our workings will be investments. So this is what we actually received. So we received 2,400. So we know we received that amount this year. That's essentially what the investment company had paid us. Now, we already know that we were due 300 from last year. And if we go back to the adjustments that we were talking about earlier, we saw investment interest due on the end of 2015 was 400 euro. So essentially, they have given us 2,400, but they owed us 400 more that they still haven't paid us. And part of that 2,400 is 300 euro that they owed us from last year. So just like anything in financial maths, I'll just write that in here first. In financial accounting, 400, and it's due this year. When we want to find a specific figure for this year, that's all we're interested on. It's like the profit and loss account is only based on this year. So we don't really care about 2014. We don't care about what we should be receiving 2016. We're just focused on this year when we're looking at income and expenditure. So of the 2,400, 300 I should be taking off because they owed it to us from last year, but they've only paid it this year. So that means that 2,100 of the money is for this year, and then they still owe us 400. So in total, they owe us 2,500 of investment interest. Now, if we go back to the question, we can see that the 2,500 is 4% of our initial investment. 4%. We want to figure out what our actual investment was. So we divide 2,500 by 4 and multiply by 100. And that is 2,500. Now, so what I would do is I get my red pen. Now, we already know that investments due from last year will be in the accumulated fund. But now we have an investment, which is an asset, of course, which we have is also going to be in the accumulated fund. So all of this adjustment was 1. Now, and this will be going in as an income. So when we do our part B, or what they ask us for an income and expenditure account, that will be going in there. Because of course, for an income and expenditure account, again, it's just like a P&L account. We're only interested in what we are supposed to get paid this year. So that's the 2,500. Now, so that's a lot done with just that small adjustment. We're now going to look at the bank account adjustment, or the bank loan adjustment. So we have a bank loan. So the details are nearly always the same when they come up. We're told a bank loan plus 15 months interest paid at 8% on the 31st of 12, 2015 is 33,000. So you have 33,000 is inclusive of the bank loan plus the interest, which is 15 months. 15 months. Again, so this was paid on the end of 2015. When we're doing the income and expenditure, part of the question, we're only interested in this year. So we know that interest is 8%. So the best way to do this question is to say, okay, we know that 8% per annum. Okay, we know that we've paid interest for 15 months. So what I would do is I would get that 8 divided by 12 and multiply by 15 months. Because we know that the bank loan is going to be 100%. And we know that the interest is 8% plus 3 over 12 of 8%. We can say this together is 15 over 12 by 8%. So what I mean by that is we can now just say 8% divided by 12 multiplied by 15, and we get 10%. So if we just want the bank loan and just want the interest we paid, 33,000 divided by 110, and then we multiply it by 100, will give me the bank loan. And if we multiply it by 10, it will give me the interest. So 33,000 divided by 110 multiplied by 100 is 30,000. The interest is 3,000. So interest on a bank loan is an expense. The bank loan itself is a liability. So the 3,000 is a liability. Well, I'm not going to write that. I'm going to say the accumulated fund, ACF. Now we have to break this 3,000 up into, well, we're going to have to break it up into this year and last year. So what goes into the expense is going to be 8% of 30,000, or you could say 3,000 divided by 15 multiplied by 12. So 3,000 divided by 15 multiplied by 12 is 2,400. So that's for this year. Wrong color. And 600, that is going to accumulated fund. Why is that going into accumulated fund? Well, this is technically loan interest due. So on the 1st of 1st, so we haven't paid off the bank loan and interest until the very end of 2015. So that means at the beginning of 2015, there was 3 months. So let's say we took out the bank loan in the beginning of October. Yeah, so the very beginning of October or the very end of September, we took out a bank loan. Say it was interest for all of October, all of November, all of December. That 3 months, which is €600, has to go into the accumulated fund because the interest was due, we didn't pay it. And and then the remainder will be going into our receipts and payments later on, or expenses later on. And that's the bank loan. So that's nice. We have loads there now for the accumulated fund. We have a lot for our expenses as well. So we have a lot of kind of marks picked up here. We just now have to slot them into the accumulated fund as well. So the last adjustment I'm going to do, because it's quite long and we will need it for the accumulated fund, is the subscriptions. So the subscriptions is a nice one. We get a lot and we get a lot of information from it. We get a lot of figures and marks from it, and it's only a small bit of adding and subtracting, and remember the gain, due and prepaid. So if we go back to our question, we are told that we have subscriptions 102,900. So we'll just say receipts 102,900. So this year we are basically having cash 102,900 that were subscriptions. But from the receipts element of the question, it doesn't give us any notes. So we have to go down here to get these notes that we're looking for. So as well as that, we know of your subscription received in advance of 1,400. So there's 1,400 that was subs prepaid for 2015 even. So we have to add that on, because remember, anything that is supposed to be paid this year must go into the income and expenditure, just like a P&L. So if we were prepaid 1,400, that means it has to be due for 2015, or it's a payment for 2015 that we were given in 2014, so it must be added on. Now we go back to our little adjustments, all right, and they say 2 life memberships, bringing the total life membership to 10. This is a standard adjustment, so straightforward. So it's like, okay, well, they're telling me there's 2 life memberships, but they're not giving me any figures. So we now know that there's 10 life memberships now, but initially there was 8. So at the start of the year, there is 8 life memberships. That's a little trick for this question. And we already know that there's life memberships of 40,000. And if there's 8 of them, 8 members, well, 8 divided by 40,000 means that we charge 5,000 for a lifetime member. We can go over here and we say, well, it doesn't really matter what we say, but we say part of this were life memberships, members by 2, and it is 10,000. Do we treat life members separate to subscriptions? We sure do. Life memberships are liabilities, not income, so we must take it away from subscriptions. Now, this does not go into the accumulated fund because this happened in 2015. Okay, we're only interested in the accumulated fund of assets on the 1st of 1st, 2015, whether this happened in the end. What else are we told? Subscriptions for 2016 amounting to 800. So we're only interested. So these are subs prepaid for 2016. We are only interested with 2015, so you have to take that figure away. So there are some really organized people, and they said, you know what, I have €800, or sorry, I have, I don't know, whatever the subscription is spare, I'm going to give it to the club so I don't have to worry about that next year. So it's great for them. For us, it's kind of a bit of a pain, I guess. Now, it's nice that we get the money in advance, but it's still seen as a liability because it's again prepaid. So that is minus 800. Now, the other 2 easy ones is the levy for 2015 is €50 each on all. So we have 500 members this year at €50. So 50 by 500 is 25,000. Yeah, 25,000. So now we know again a levy for 2016. Sorry, levy for 2015, is it? Levy for 2015. We're going to take that away because we know, again, levies are liabilities. They're inputted in the receipts as just a broad name of subscription, but we know that there's 3 different kind of elements to this. We have life members, we have the levy that we charge our subscribers or subscriptions, and then we have just the membership or the subscription itself. Now we also have a levy for 2014. So what does this mean? So there's 50, so levy for 2014 is €50 for 20 members. So that is €1,000. So essentially there is people who were members in 2014, never paid their levy, so we're now charging them. This money is essentially a gain due. So a gain due goes into the accumulated fund as an asset. So this is kind of one of the tricks of the question. You really have to, now it is a trick for the first time, but then they do it all the time. So once you've done 1 or 2 of these questions, you always see there's a levy for 2014. You must take it out of subscriptions from the receipts and add it to your accumulated fund as an asset. And you get 2 marks for that, and you get another mark or 2 for your subscription being closer to being the correct figure, which you get a lot for. So if you, I guess, add all those up now at the moment, you should get 67,500. And that is a figure that will go into our income. Perfect. And you get something like 6 marks. So that's 10% of the whole question is going for this figure. Now we should have everything we need for our accumulated fund. So I'm just going to jump straight into the accumulated fund, and then we'll finish off the rest of the adjustments to do the income and expenditure. So here's the accumulated fund. We essentially just have a list of assets, a list of liabilities, and then get the total accumulated fund. I'm just going to do assets. So what are all the assets we've had? Well, we go back to the very beginning of the question. We know we have clubhouse and course. We have bar stock and equipment. So I'll just write all these in and go through the question. So these are everything that were in the top of the question. So all our opening balances, I guess. Now we're going to add what we've already looked at. So we've looked at, well, the easiest one to look at is our bank current account balance. So we are in payments, which means it's an overdraft, so it's a liability. So I'm just going to go over here. Bank overdraft. $8,500. Nice and simple. So then we go back to our adjustments. Well, we've said that we have 62,500 for investments and 30,000. So 62,500 are investments. So you know investments are separate to investment interest. So investment interest is a gain, but a gain that is due is an asset, but investments themselves are also an asset. And then the bank loan is a liability, and that was 30,000. But we also discovered that there was bank loan interest that wasn't paid for 3 months. And we also said that there was a levy due. So there's a levy. Oh, sorry, that's in the wrong spot. So there's a bank loan interest of 600. And here there was a levy due, which we said was 1,000. So we know that levy itself is a liability, or a levy reserve fund is a liability, but a levy due means there is a payment that we were supposed to receive, which is a gain. It wasn't paid, so it's a gain due. A gain due is an asset. So these should be all the figures we need. Yeah. Yep, so they're all the figures we need. Add them all together. We know this is, well, I can see this is 744,155. Here we have 135,000. Put those together, 609,155. And we call that the accumulated fund and then we give the start. And that's 25 marks. So that is a pass straight out the gap through that. So now what we might do is do a few more workings or work on anything else you might need to work on before we do our income and expenditure. So we have more workings just to make it look a bit nicer. So we did bank loan, we did investment interest. The only real one we need to do, let's say, is our special purpose account, which is our bar. And then there's only other little things here we need to look at as well. So the bar is kind of the next one, which is quite big. I guess there's a lot there. So bar. Okay. So the first thing we want to look at is, we'll just do like as if it's a small P&L. So we know there's going to be sales. So we have bar sales, 76,300. We have bar purchases. And we also have stock as well. So sales, we have opening stock. So like, let's say less cost of goods sold. We have opening stock. We have purchases. And then we have closing stock. And then we'll end up getting bar profit. So very similar to, well, identical really to anything we would do for a P&L. The only thing we have to look at is, okay, so we have bar receipts, 76,300. Now, part of that 76,300, so we received all that as cash, let's say, so that's all the payment we received. However, there was bar debtors of €355. What that means is that of the 76,300, 355 was not for this year. And if we scroll down, we have bar debtors for this year that haven't paid of 500. So you'll have to add the 500 and take away the 355. So for example, the sales is still going to be the 76,300. We're going to have to take away 355 and add the 500. Because remember, we're always interested in P&L of not so much the cash movements, but what we should have received. So even though we have debtors, we know that, well, we're only interested for the P&L or the income and expenditure in terms of what was taken out of stock, let's say, or what was bought. We don't care if it was cash or credit, we just want to know what was taken. So if you add all them together, we get 76,445. Less cost of goods sold. Our opening stock, well, we have our opening stock here, 6,000. Our purchases, so the same thing as our sales. So we have 33,600. We take away opening, we add closing. Our opening was 3,000. Our closing was 1,230. 1230. So if we add all that together, we would get 31,830. If we then add them together, 37,830. Closing stock, again, if we go back, have a look, our closing stock for the bar is 16,900. So we take this away from our purchasing figure, because essentially, if we bought goods worth 33,600, but we haven't used 16,900, well, we can't say it's applicable for this year. So it's going to be used up next year. We're only interested in what's supposed to have gone through this year, so we have to take that figure away. We get 20,930. That means our bar profit is that take that, which is 55,515. So that is our bar profit. And doing all this will get us a lot of marks for our income and expenditure accounts. Now, what are the other adjustments? You might as well do them before you do anything else. So what have we done so far? So we'll do our catering stock now as well. So catering is, do we have two? We have catering receipts, catering purchases, and we have catering stock. But I don't think we have any opening stock for catering. No, so catering will be quite straightforward. So catering, so it's going to be the sales. So we have the sales element. We're going to take away the purchases. And from the purchases, we're going to take away the closing stock. So essentially that's going to be an add. So we have sales 6548. So 6,500 minus 4,800. The closing stock for catering is 600. So essentially 6,500 minus 4,200 is profit of 2,300. So that's obviously an income. So they're both income figures. So in terms of adjustment done, we dealt with everything investment wise. So we now have to do depreciation. We've done everything to do with subscriptions. We've done anything to do with the bar debtors and creditors. So equipment owned to be depreciated 20% of cost, and clubhouse and course be depreciated. So we've bought equipment throughout the year. So that's one kind of trick. And we already had some earlier. So you have 24,000 plus 18,000. Depreciation. So you have 24k plus 18k at 20%. And we have the clubhouse depreciation, which is 650. Nothing was bought at 2%. And that will give us depreciation of 8,400 and 13,000. That was straightforward enough. 2 done. And now we're in the last 2. So the clubhouse has decided that life membership is to be credited to income over a 10-year period commencing in 2015. So we have we're told that we have 10 life memberships. We know the 8 was 40,000 up here. we added 2 more at 10,000, so that means our life memberships is 50,000. So total 50k. We're writing them off over 10 years to our income, so 5,000 euro must go to income. And this is kind of always the case with these questions as well. This is a very similar adjustment that comes up, or sorry, a very standard adjustment that comes up. Now, that's that done. Now the last one. The dishonored check was not subsequently recovered and was written off as a bad debt. So essentially, this dishonored check that we see in payments, it's kind of an adjustment that might confuse you, but basically what it's saying is that we had a dishonored check from a debtor. The check has bounced, or the check hasn't gone through, and we don't believe that this debtor will pay us the 80 euro that they owe us. Maybe they've left the country or left the local area, or you never see them anymore, and you're like, do you know what, it's not worth chasing them. It's 80 euro, we're just going to write it off as an expense. So all you're basically doing is in the income and expenditure, you're going to put the 80 euro in as an expense. So with that, we will do exactly that now. So income and expenditure account, income, and I'll just down here, I'll do expenditure. So I'm just going to put an asterisk on stuff we've changed, let's say. So kind of the box is the easiest to kind of look at. So we know that subscriptions has changed. We know we've done stuff for catering. We've done stuff with bar receipts. We haven't done anything with entrance fees, annual subscriptions. So competition receipts. So we have competition receipts and competition prizes. So we should probably just net them off. So I like to do net. So competition net. So if you get those two figures and take it away from each other, we should get 3,500. Now, if we get a grant for equipment, that would go into the balance sheet. So we are not asked to do a balance sheet because it's only 60 marker. So this is essentially what we call a red herring, or something we don't need to work with, a bit misleading. Sundry expenses, we might have to do something small with that. Equipment, so again, equipment does not go into our expenditure because it's a asset. So again, another red herring. Catering, and we've already dealt with bank loan, dishonoring check. So we now, because we've done catering receipts, we don't actually need to input this because that is already accumulated over here in catering receipts. Same with bar purchases, so that doesn't need to go in because we've got a net figure over here. Let's say the loan doesn't need to, but loaner payments do, and that should be enough. Now, the sundry expenses is something that we just have to have a quick look at. So if we have sundry expenses, which is just like miscellaneous or just like normal expenditure with like, it's a big heading where we could have any kind of amount of expenditure going on throughout the club. So if we've paid 124,350, but we know that wages due from last year was 1,500. Well, part of that sundry expense is wages due. We're only interested in what is happening for this year. So you'll have to take away the 1,500 from the sundry expenses. So minus 1,500, and that figure is 122,850. Okay, so we should probably be putting that in the adjustments. Like, it's just a 2-line adjustment. It's not a big deal, but it's just something that we have to be able to look out for. So what do we have? So we have bar profit. We have investment income. So these are what we were doing adjustments for. We had subscriptions. We did a lot of differences with subscriptions. We did life memberships. So these are the life memberships that we have written off to income. So we're kind of like, okay, they're a liability, but essentially we should be kind of realizing some of that money every year. So we're saying, you know what, we're now going to start no longer take life memberships, and we're just going to slowly introduce them into income, so it doesn't look like all of a sudden we have, let's say, what was the figure for life members, 50,000. We don't just have 50,000 coming in this year and nothing next year. We're kind of slowly bringing it in. We've catering profit. We have competition profit. So these are all just like adding the income and taking away the expense for some of these ones. We have entrance fees, and we have sponsorship. So these are all the things that we've either have adjustments for or stuff that we can just see in kind of the box, receipts and payments. So there's not that many expenditure because we actually have dealt with a lot of them in the catering and the bar. So we have sundry, loan interest. So this is an adjustment we did. We have then depreciation. So depreciation of Clubhouse. So it's Clubhouse and course, but I just won't write that. And depreciation of equipment. We have bad debts. So we were telling you that €80 for bad debts was written off, so it must go into an expenditure. And that's all we have. So if I just scroll up a small bit to get everything in. So now all we have to do is make sure that we've done all the hard work and the heavy lifting. We just have to make sure that we're now actually taking the right figures. So bar profit was 55,515. Our investment income we said was 2,500. And where is it? Up here. So remember, anything that goes into the P&L or the income and expenditure is always going to be your sorry, that's wrong. It's 2,500. 2,500. Subscription, so we have that figure as well somewhere here. So 67,500. Life membership, we said we wrote that off, it was 5,000. Catering profit, we put it over here. Where is it? 2,300. Competition profit was 3,500. We just did the small workings at the front of the sheet. Entrance fees came straight from the question, 10,000. Annual sponsorship, 11,400. So if we tally all them up, we have 157,715. Now, sundry expenses. So when we did the little bit of work on the sheet, we got 122,850. So we'll just do 122,850. So that was when you took away the wages due. The loan interest was 2,400. So just to show you, where are we? Right here. So you said that 15 months loan interest was 3,000. We paid 15 months at the very end of 2015. That means that 3 months were for 2014. So there's 12 months is 2,400. And that is only for this year. Now we're only interested in figures for this year. Clubhouse depreciation, we had 8,400 for the delivery or for the equipment, and 13. So 13, 8,400, and we said that the bad debts was 80. So kind of a strange one to ask, but I think it's just to kind of help people who might have been struggling with the question. Kind of just throw a spanner in the works, makes you like, okay, will people actually know what to do with this? So this is a surplus. which means we have surplus is more money, deficit is less money. So surplus of income over expenditure of how much? 10,985. So we have more income than expenditure. That's my answer. So there's 27 marks going for all of that. The most amount of marks here are going for subscriptions, because of course there was a lot of information we were pulling from subscriptions, we were adding and taking stuff away, and bar profit. So we had 6 marks for subscriptions, 4 for bar profit. Now, last bit of the question, never forget, is the theory. So what is a levy, what is a life membership, and how do you treat them? So a levy is a payment made to a club, to its members, to fund a special project such as a clubhouse extension. So the most important thing is that we allude to it being a special project. It must be used for the purpose for which it is collected, so in some way similar to a grant. It is a capital receipt, a once-off basis for a specific number of years, and is credited to a reserve fund. That's why it's a liability, it's a reserve. It is due to the members until it is used, so it is treated as a long-term liability in the balance sheet. So essentially, the members are kind of like creditors. So until we've used the money, it will be treated as a long-term liability. Life membership, this is where a club member pays a fee that entitles her or him to use the facilities of the club for the rest of his life. Quite straightforward. It is treated as a long-term liability in the balance sheet and can be written off to income over a stated number of years. So you might see something like that in a question 1 company account, where you have a patent and you write it off. So a patent is an asset and you'd write it off as an expense over the years. So this is the exact opposite. We have a liability and we're writing it off as an income over 10 years in our case. So that is the question. That's 8 marks there. Even just describing the two would get you half marks at least, but you already know it's a liability, so you just say it's a liability. Even that would kind of get you more marks as well. So these can be quite subjective, some of these theory stuff. So that is the end of this question. And not only should this help you obviously with club account questions, specifically 60 mark club account questions, but it will really kind of back financial accounting and help you with questions like question 1s, your understanding for question 1s, which most people tend to do rather than 2 60 markers. So thank you very much for watching. If you have any questions, please let me know. Goodbye.